Assalamualaikum. Hi, my name is NURUL ATIKAH binti SHUKOR. I'm from AC220 My group will present our answer of the group project question that was assigned to us last month. Before that, I will introduce our group member and which question we will present. Me, ATIKAH SHUKOR, and DEAYANA will present our answer on question 1, while Hanisah Halid and AZIAN will explain our answer of question 2. Now, let's start our presentation.
So, when the company is growing, how do they manage to find their company for project? So, there are two options, which is packing order theory and also trade-off theory. But before that, a company needs to reach an optimal point of capital structure of the combination of debt and equity financing that can minimize a company's market value and to reduce the cost of capital in order to avoid the risk. The higher cost of debt and the higher financial risk to the shareholder due to so much debt in the company. In order to determine the optimal point, the company needs to use the weighted average cost of capital WACC by calculating debt to equity ratio that will show a lower WACC, which can raise the market price, lower the cost of financing, and minimize the risk in solvency. The optimal capital structure point is to determine the proportional debt return equivalent to the proportional debt cost. Next, what is the differences between packing order theory and trade-off theory? So, trade-off theory is focuses on trade-off which include the value of debt shield and the cost of debt. As for this ratio, the debt to equity ratio remains same as the firm's asset and operation has a great consistency as a whole. Furthermore, this theory will balance the gain of debt with the cost of debt in order to determine the optimal amount of debt. By using debt, it can lower cost of tax as interest on debt is deductible by taking on debt creates a tax shield. This theory is more to give solution for the leverage, but a firm needs to react rapidly when bad shocks occur. In contrast, packing order theory focuses more on to the firm to decide where to source their financing. This theory will trust all internal financing such as sales of stock through retained earnings. As I mentioned before, firms use internal financing as it is the most convenient and the most cheapest as it will decrease the risk of the company. Moreover, this theory do not use debt to equity ratio as it using two ways, which is internal debt and also external financing. As for this theory, if the firm does not have sufficient amount of internal financing, then the firm will use debt such as selling their bonds as their financing and external financing for their last source, which is equity by pledging their asset, as this option will require a higher demand in return. This theory shows that the firm can rely on their funds and ready to take risks in order to meet their financial obligation.
Now, I will explain about the financial hierarchy of packing order theory and trade-off theory. Based on what presented on the screen, packing order theory suggests that managers may use various sources for raising funds in the following order. Number 1, managers' first choice is to use internal financing. As what we learned in class, internal financing means retained earnings. In absence of internal finance, they can use debt. For example, secured debt, unsecured debt, hybrid debt, and others. Then, managers may issue new equity shares as a last option. Based on our research, packing order theory is based on asymmetric information, which refers to a situation in which different parties have different information. In a company, managers will have better information than investors. This theory states that firms prefer to issue debt when they are positive about future earnings. Equity issued when they are doubtful about the company's future earnings or internal finance is insufficient. Now, Trade-off theory of capital structure refers to the idea that a company chooses how much debt finance and how much equity finance to use in the capital structure by balancing the costs and benefits. When a firm adds debt to its capital structure, they will gain advantage because the tax benefits which call tax savings. However, there is also cost of debt financing, which called financial distress cost. Trade-off theory implies that a firm's capital structure decision involves a trade-off between the tax benefits of debt and the cost of financial distress. Trade-off theory basically entails offsetting the cost of debt against the benefits of debt.
Hi, my name is Hanisah. I and AZIAN will be explain how we answer question 2. Before we go on to the calculation, let me explain a little bit how arbitrage process. Arbitrage is a way to make a riskless profit. It sounds too good to be true, but this situation arises often. What you are doing is buying something in one market and selling it in a different market. And if we can make those transactions as simultaneously as possible, we are locked in a riskless profit. Arbitrage exists because of some mispricing in the market. Usually, the way to take disadvantage of arbitrage is to be really fast, since a lot of bots are created to look for arbitrage opportunities. For example, there are two markets, Market A and Market B. Market A stock price are 20 ringgit while B has 25 ringgit. So what we're gonna do is we buy stock at Market A and sell the stock at Market B. 5 ringgit difference we can say as riskless profit due to mispricing in the market, or we can say incremental income due to arbitrage. Arbitrage also have advantage and disadvantage. So advantage of arbitrage is, first, it is a risk-free trade, as the trader has not to be scared of while carry out arbitrage trading, since they took advantage of the miscalculation or the efficiency in the updating of price in the stock market. Number 2, it doesn't give a trader the normal trading feeling like pressure, intense or emotional stress, since the trader already know how much the profit he will make from the arbitrage trading. Number 3, it is a means to earn free money in stock, as you stand a chance to lose no real fund while trading arbitrage. And disadvantage of arbitrage is, first, the profit that can be achieved in the market through arbitrage is usually limited and small, because most of the time brokers can make technical errors that can lead to great difference in price. The second one is the calculation involved for determining a trade that can be suitable for arbitrage trading in the stock market can be very difficult to carry out. And the last one, arbitrage opportunities are not always common in the market, and this can make a trader search all day or weeks and not even get one arbitrage trading opportunity. To further understand this process, it will be explained more in the questions. In this case, we start with finding total market value for both companies. Total market value for Nel Berhad, which is unlevered company, and Mystic Berhad, which is levered company, is 1,200,000 and 937,500 respectively. As we can see, the value from Nel Berhad, which is unlevered company, is more than Mystic Berhad, which is levered company. Currently, Mr. Z is holding 15% of shares from Nel Berhad, which is unlevered company. Hence, the value of investment made by Mr. Z is amounted to Rm 180,000 by calculating 15% of the total market value for Nel Berhad, and the return on the investment made is amounted to 22,500. After calculating the cost of equity of 12.5% with the value of investment. So, the decision made from our group will be explained by our member group, which is AZIAN, on how to maximize Mr. Z return on investment, whether we want to choose Nel Berhad or Mystic Berhad. Thank you.
Moving on to the alternative strategy. After discussing, our group has decided that Mr. Z should sell his 15% shares from Nel Berhad, which is an unlevered company, and then buy shares from Mystic Berhad, which is a levered company. The reason we chose this alternative is because the market value of Mystic Berhad for their debt and equity is in the ratio of 1:1, which represents 500,000 ringgit for each debt and equity. In order to maintain the level of risk of the company, Mr. Z should lend a proportionate amount of 50% and then invest the remaining amount in the shares of Mystic Berhad. As we can see in the table, 50% of shares amounting to 90,000 ringgit should be lent by Mr. Z, and then another 90,000 ringgit should be invested to buy the shares in Mystic Berhad. This situation is what we call as homemade leverage, where investors make personal borrowing or lending in order to increase or decrease leverage respectively. For example, if an investor wants to increase the leverage, they should borrow money to buy new stocks. However, if an investor wants to decrease the leverage, they should sell their stocks and then lend the money instead. Now, as per the table that is shown on the slides, with the new shares bought in Mystic Berhad, Mr. Z will be able to gain an income of 14,400 ringgit by calculating the shares invested with a cost of equity of 16%. He will also be able to gain an interest from the money lent of 9,000 ringgit by calculating the money lent with the percentage interest of debt of 10%. Thus, the total return of investment made by Mr. Z in Mystic Berhad will amount to 23,400 ringgit. Next, the return on investment for both companies is to be compared. Mr. Z will be able to gain a profit of 900 ringgit by subtracting the return of investment from Mystic Berhad of 23,400 ringgit with the return of investment from Nel Berhad of 22,500 ringgit. The value profit of 900 ringgit is due to the arbitrage process where the investor, Mr. Z, sells the shares from Nel Berhad, which has a higher value of the firm, and then buys the shares from Mystic Berhad, which has a lower value of the firm. Therefore, the transaction will push down the value of Nel Berhad and then increase the value of Mystic Berhad until the equilibrium is reached. This particular process also gives Mr. Z a gain, where the risk position is the same but still able to give him a profit. In a nutshell, in order to maximize the return from investment made by Mr. Z, he should sell his 15% of shares from Nel Berhad and then buys the shares from Mystic Berhad to gain a profit of 900 ringgit by taking advantage of the arbitrage process where the perceived risk is the same but still able to give him a profit.
In conclusions from question 1 above, under pecking order theory, firms are preferred for using their own internal fund as their sources of finance. But in order to fulfill the obligation, if the internal funds are not sufficient, firm then use debt and issue new shares as their last choice. Pecking order theory prefer to use safe security as their first priority, and debt when they are confident about the future earning, and equity when the firm funds are not insufficient. Other than that, managers are the one who know better information rather than investor, as this theory uses asymmetric information in which different parties have different information about the firm. Under trade-off theory, firms are balancing between two things, which are their cost and his benefit. In order to do that, firms need to choose how much to use debt and how much to use equity. In this theory, firms can enjoy a tax shield since interest on debt is exempted from taxation. Thus, it will reduce the cost. However, firms have the obligation to pay interest to their bondholder, which will result in interest risk. And last but not least, based on question 2, it can be seen that the investor, which is Mr. Z, gained 900 due to arbitrage. This is happening because of mispricing in the market, which will give benefit to the investor to enjoy risk-free profit, even though the profit are small. However, we must know that arbitrage is rarely in the market and very difficult to find out since it is impossible for broker to miscalculate. Lastly, question 2 shows us that in order to maintain the financial risk of the company, we can use the strategy of homemade leverage. This strategy itself gives an exposure to the investor to increase the leverage or decrease the leverage. In question 2, Mr. Z took 50% of his share and lent the money. In result, he can get profit from shares and profit from interest lending the money. So that's all from our group. Thank you.